All right, let's talk about something that I know can sound a little dry: inventory accounting. But here's the thing. This isn't just for the number crunchers in the back office. Not at all. We're going to treat it like what it really is: a powerful, strategic tool. Because when the economy starts to get turbulent, your accounting choices can become one of your most effective weapons.
So, let's put you in the driver's seat. Picture it. You're at your desk and a new economic report lands. The headline just jumps off the page. Inflation is surging. What do? What's your very next move? Because for a manager, that's not just news, that's a direct challenge to your business.
You see, in that single moment, your world has completely changed. This isn't some abstract theory from a textbook anymore. This is a very real, very powerful force that's about to slam into your operations. And here's how it hits you. Inflation means that the cost of all the stuff you need to buy, your inventory, is going up. The parts you bought last month are suddenly a bargain compared to the identical ones you have to order today. And that price hike flows directly into your financial statements, and it can seriously start to eat away at your profits.
But here's the good news. You are not helpless. You have two main accounting tools to fight back with. And the choice you make isn't about bookkeeping. No, it's about picking the right financial strategy to get through the storm. So let's meet our two contenders, FIFO and LIFO.
First up, we've got FIFO. It stands for first in, first out. And honestly, it's the most intuitive way to think about it. Just picture a grocery store stocking milk. They put the new cartons in the back and slide the older ones to the front, right? So the first milk that came in is the first milk to go out. Simple.
And then there's its complete opposite, LIFO, or last in, first out. This method assumes the absolute newest stuff you bought is the first stuff you sell. Imagine a big bin of nails at a hardware store. Customers just grab a handful from the top of the pile, the ones that were most recently dumped in. They're not digging down to the bottom. That's LIFO in a nutshell.
So why does any of this matter? Well, this right here is the heart of the whole strategy. In our inflation scenario, FIFO matches your old, cheaper inventory costs against today's higher revenue. This can make your profits on paper look absolutely fantastic. LIFO, on the other hand, matches your newest, most expensive inventory costs against that same revenue, which gives you a much more realistic, up-to-the-minute picture of your actual profitability.
And that puts us right back in the manager's chair, facing this dilemma. Inflation is running hot. You know your tools. You can go with FIFO and report those awesome-looking profits, or you can go with LIFO, which more closely matches what's happening right now. It is time to choose your path.
So, what's it going to be? Let me put the question plainly. When the cost to replace every single thing you sell is going up day after day, which method is actually going to protect the real financial health of your company?
Okay, let's break down the consequences. Let's really analyze the impact of this decision, because this is where the accounting choice stops being theoretical and starts getting very, very real. Look at this. It's like a chain reaction. When you use LIFO, you're using your most recent and therefore higher cost inventory first. That makes your cost of goods sold go up. And if your costs are higher, well, your reported profit is going to be lower. And now, here's the crucial part. A lower reported profit means your taxable income is also lower.
This chart just drives the whole point home. I mean, look at the difference. That FIFO bar represents a much bigger tax bill. The LIFO bar is way lower. And that gap between them, that's not just an empty space on the chart. That is cold, hard cash that stays inside your company.
So the crucial point is this. When inflation is raging, choosing LIFO can literally reduce your current tax bill. And this isn't about dodging taxes. It's about freeing up critical cash flow, cash that you can then use to reinvest in the business, especially when the cost of everything is climbing.
But, a great strategist never assumes things will stay the same. So what happens if we flip the script completely? What if the economy cools down and we enter a period of deflation where prices are actually falling?
In a world of deflation, the entire logic gets turned on its head. Now, your newest inventory is the cheapest, and that older stuff you bought a while back is the most expensive. All of a sudden, FIFO becomes the smart tool that matches higher costs against revenue, which in turn can lower your taxable income. The best method completely depends on the economic weather.
And this all brings us to the big strategic takeaway. This whole exercise is about changing your mindset, from thinking like an accountant who just reports the numbers to thinking like a strategist who uses those numbers to win. And this quote just says it all perfectly. This decision is not some minor accounting detail that you can just delegate and forget about. It is a fundamental management decision, and it has real, tangible consequences for your entire company.
So, let's just quickly recap the key takeaways.
1. Accounting is a strategic tool, not just a reporting function. 2. During inflation, LIFO can be your best friend for saving cash by lowering your tax bill. 3. When deflation hits, FIFO might be the better play. And 4, the most important one of all, the best strategy is always context dependent.
Which leaves us with one final question for you to really think about. Is your company's accounting just a report card, something that tells you how you did last quarter? Or is it a playbook, a dynamic set of strategies you can use to actually win in the quarter to come? The choice really is yours.